In our first video, we introduced an example of an algorithmic strategy trading gold. If someone were to start trading a strategy like that live, they would very quickly run into a fundamental statistical reality. Up until now, the strategy has promised beautiful profits. But the moment you launch it on a live trading account, you hit a loss, then another loss, and then one more. That is the moment you shut it down in frustration and say something pretty vulgar about the market. What happened? Why does this occur? And how can you prevent this scenario? That is what today's video is all about. We will show you that a portfolio of strategies is the primary tool of any serious algorithmic trader.
Welcome to the world of algorithmic trading.
In this educational series, we explore whether it's possible to develop a robust trading strategy. Is it achievable? Let's find out together. Disclaimer: trading involves significant risk and may result in capital loss. This video is for educational and informational purposes only and does not constitute financial or investment advice.
So let's start today by looking at the backtest statistics of a specific strategy. You see the chart, and you're already imagining your account growing exactly like that, seeing your balance grow. However, once you go live on a trading account, a loss arrives, and potentially several losses in a row. At that moment, you feel like shutting everything down in disgust. But you hold on. Then, however, another loss comes. And then the strategy doesn't make a single trade for 2 months. And then, another loss. It's enough to drive you absolutely crazy. Unfortunately, in trading, losses are perfectly normal. When you look at an equity curve like this, it looks like a dream come true. The problem is that we are looking at the strategy's performance over several years. We are viewing it from the perspective of months. Try taking a magnifying glass. Let's zoom in. If we magnify the view, we see that it is quite common to find losing years every now and then. Let's zoom in closer. Even when a year is profitable, we often see losing months within that year. Let's zoom in even further. And now we are looking at the list of individual trades. You can see that the strategy sometimes earns a little, sometimes more. Other times, a few losses come. Then a few more, then one big profit, then a few more smaller losses, and it just goes on and on like this. If you monitor trading at the level of individual trades, it is psychologically very unpleasant. Losses hurt. You'd like to shut everything down. Profits feel great. You'd like to increase the strategy's capital. But then the losses come back again. For a beginner trader, this can be very unsettling and demotivating. A few losses can trigger, sometimes fully justified, doubts about the given trading strategy. As a result, many newcomers lose confidence entirely and decide to quit trading, which, of course, is actually an excellent idea. A beginner has no business trading in the financial markets. They should only be learning, for at least several months, but preferably years. That is what demo accounts are for. A series of losses in algo trading is a completely normal situation. Every trading system, regardless of its quality or historical success, goes through periods where it underperforms. For example, breakout strategies are built on this very approach. They often achieve a win rate of less than 40%, which means, for instance, that 7 trades out of 10 will be losers. These losses can also appear in a series, say 10 or 15 losing or break-even trades in a row. But then comes one profitable trade. That trade is so large that it can cover all previous losses and still bring a profit. Such strategies are extremely demanding on a trader's psyche. If the robot records a series of losses, you cannot say with certainty if or when that dream winning trade will finally arrive. It also works the other way around. There are strategies that achieve a win rate of more than 90%, which at first glance sounds like the holy grail of trading. However, such results are paid for with extreme risk asymmetry, meaning rare but very large losses. The result is a series of many winning trades, one after another. The robot just keeps earning, and its equity curve rises almost without interruption. But then comes the inevitable. a market shock. It is so large that it can hit a distant stop loss or wipe out your trading account. One big loss can then often erase all previous profits from several years. After such a loss, another series of winning trades may follow, but a series of deep losses could also follow. These occasional drastic equity drawdowns are usually very painful and psychologically taxing for traders. Markets are dynamic and unpredictable, which is why even the best robot cannot achieve only winning trades without losses. For this very reason, it is unwise to rely on just one trading system or one strategy. The old saying applies here too. Don't put all your eggs in one basket. The solution to this problem is diversification. By using multiple, robust trading systems that differ in their strategies, assets, or time frames, you can mitigate the impact of one robot's losing periods and achieve more stable results. Diversification thus not only helps minimize risk, but also helps build trust in the trading systems, which is crucial for beginner traders. Primarily, diversification reduces volatility and drawdown while maintaining a positive expectancy. Let's look at an example of 3 common trading robots. They aren't high-end systems. They are standard robots that even a moderately experienced trader could build themselves. After all, let's be realistic. If someone had a top-tier tool for reliably trading the markets, they wouldn't be showing it all over YouTube. If too many people started trading it, the market edge it exploits could gradually disappear. So let's look at 3 different trading systems. I intentionally chose a period of major market fluctuation, the COVID era from 2019 to 2023. 1. First, let's try a Forex system on the GBP-JPY pair on a 1-hour time frame. In early 2020, a drop occurred, and it stagnated until 2021. A year of stagnation is a fairly unpleasant thing. Shut it off? Let it run? 2. So let's try another robot. Let's trade gold on a 30-minute chart. In 2019, it stagnated for almost 3/4 of a year. Then it stagnated for almost the entire year of 2022, only to erase nearly all the 2022 profit at the beginning of 2023. 3. So, for the 3rd time, let's try our luck on the daily time frame and trade the S&P 500 index. Here, however, we have a smaller number of trades per year. In 2021, the system didn't trade at all. Frustrating. So, what now? Do we pack it up and quit? I don't like any of these robots enough to want to trade them individually. Now is the moment when the magician pulls the rabbit out of the hat. That magic is the portfolio. If you trade these 3 strategies simultaneously, a new chart is created. This is the equity curve of a portfolio of the 3 strategies we just showed individually. You can see that something is always happening here. The periods of stagnation are shorter. This is what the overall portfolio looks like, and within it, you can see how the charts of the individual strategies developed. Despite the fact that we were working with 3 essentially weaker strategies, the equity curve smoothed out. Yes, there will still be periods of stagnation and drawdowns, but it already looks much more promising. As we would add more and more algo robots to the portfolio, the equity curve would continue to smooth out. But beware, more strategies in a portfolio does not guarantee profit. It only takes a few strategies to start underperforming, and profit growth simply stops. Here too, you need to trade strategies that have proven themselves to you in the past, ideally over a longer period on a demo account and in various market situations. Therefore, choose the most robust systems possible as your entry strategies. In your portfolio, combine strategies that do not correlate with each other. For example, if you had 5 strategies in your portfolio that all make money when the stock market rises, then during a market crash, they could all generate a loss at the same time. That is exactly what you don't want. You want to trade strategies where each one trades something completely different. If stocks fall, gold might rise. Or if one strategy on a 30-minute time frame is trading long, a second strategy on a daily time frame may be trading short. In practice, at least 3, and optimally even more different robots in a portfolio are often recommended. If you are to trade multiple strategies at once with your capital, you must trade with relatively small amounts. This is also why I use CFD instruments in trading. Regardless of their many disadvantages, when combined with a reputable broker, profit can be achieved. But it is not easy. So, how do you create diversification? Through instruments, trading direction, and time. Diversification by instruments. Instruments where relatively robust strategies can be found include Forex, for example, USD JPY. Indices, for example, NASDAQ. Commodities, gold. Each instrument has its own specifics and reacts differently to economic events or market conditions, allowing you to reduce correlation between robots. Diversification by timeframes. Trading on different timeframes allows you to cover both short-term and long-term market movements. Short-term, intraday. These are the least stable and therefore the riskiest. Medium-term, swing. These are perhaps the easiest to automate. However, there are fewer trades, so a statistical evaluation on a demo account can take a year. Long-term, D1 and higher. Daily strategies are probably the best in terms of stability, but they are also demanding to develop. A 10-year backtest sample may be too small for a robust conclusion, especially with a low number of trades. With a 30-year backtest sample, it looks better. But on the other hand, the market 30 years ago really did look different. Testing a strategy that runs on the D1 for just a year still results in too few trades. That can be discouraging. But despite that, it seems to be one of the best approaches for beginners. In a portfolio, you could have, for example, 3 strategies for gold, 1 daily, 1 hourly, and 1 30-minute. By combining time frames, it is possible to capture different market trends and volatility, thereby reducing the risk associated with a single type of trading. Diversification by strategies. Even on one instrument and the same time frame, you can trade different strategies. The most commonly used include breakout. These usually place a pending order and expect the price to continue in the direction of the breakout after these levels are breached. Pullback. Trading based on corrections within a trend. Mean reversion. Exploiting the price's return to an average value. Trend following. Following long-term trends. Seasonality. Exploiting repeating patterns during certain periods, for example, stocks rising in late autumn or dropping in February. That's the theory. In practice, it may or may not hold true. Occasionally, a shock occurs in the market where unexpectedly all instruments move in the opposite direction. In such a market environment, even instrument diversification will not prevent losses. However, with good diversification, these losses tend to be lower than if you are trading a single instrument. The benefits of diversification only apply if we are working with robust and high-quality algo systems. You cannot just unleash a pack of terrible robots onto the market and wait for a miracle. If you launch several low-quality robots, the result will be very bad. A combination of several weak strategies will inevitably lead to losses. When you select and launch a portfolio, your work doesn't end there. Trading a portfolio requires an active approach. It's not like you just turn on the algorithmic systems and money starts rolling in. It's more like you launch it and immediately start working on developing new systems, because in a short time, some launched strategies will prove themselves and others will experience drawdowns. You will continuously turn off the bad ones and replace them with higher performing ones. That is your job in algo trading. We are essentially talking about a full-time job. It's hard work, though it's probably more pleasant than digging up a field. Trading a portfolio of multiple strategies can be psychologically demanding, even despite diversification. An algo trader should be prepared for the fact that even with a well-designed and verified portfolio, periods of loss or stagnation can occur. I'm rooting for you. If you enjoy deep dives into real algorithmic systems, please subscribe. YouTube will notify you of the next video. Thanks for watching. Trade well, and remember, trade edges, not hopes. See you soon.
If you enjoy the world of algorithmic trading, make sure to subscribe so you don't miss any upcoming videos.